Annual 1099 Report, Broker Responsibility and Financial Transparency. As we move forward from agency into the operational side of brokerage management, we now enter a critical area that many brokers overlook until it becomes a problem: financial reporting, specifically the annual 1099 report. This section connects directly to supervision because broker responsibility does not end with transactions and compliance. It extends into how compensation is tracked, reported, and documented. The annual 1099 report is required for independent contractors, which is how most real estate agents are classified under an independent contractor agreement, ICA. Brokers must accurately report all compensation paid to agents, including commissions, bonuses, and other earnings. This requirement ties directly into ARS, paragraph 32-2155, which mandates that compensation flows through the employing broker. In 2026, ADRI continues to emphasize that compensation tracking is not just an accounting function, it is part of broker supervision. If compensation is not properly documented, it raises red flags regarding compliance, record keeping, and even potential violations under ARS paragraph 32-2153. Example: a brokerage pays an agent outside of the company's standard system or fails to properly document a commission split. This creates inconsistencies in reporting and can lead to both ADRI scrutiny and IRS issues. IRS requires reporting of cooperative commissions. One of the most misunderstood areas of 1099 reporting involves cooperative commissions, payments made between brokerages during a transaction. The IRS requires that cooperative commissions be reported appropriately, depending on how the funds are dispersed. If a brokerage receives funds and then pays another brokerage or agent, that payment may trigger a 1099 reporting obligation. In real estate transactions, compensation structures have become more complex, especially after industry changes requiring clear compensation agreements outside of MLS systems. This makes proper reporting even more critical in 2026. Example: a listing brokerage receives the full commission at closing and then disperses a portion to the buyer's brokerage. That payment must be properly accounted for and may require reporting depending on how it is structured and processed through escrow. Failure to properly report cooperative commissions can result in IRS penalties and create inconsistencies that may be discovered during audits. IRS requirements: what brokers must understand. The IRS requires that any independent contractor earning above the reporting threshold, typically $600, receive a Form 1099 NEC. This applies to real estate agents working under a brokerage, as well as certain third-party vendors. Brokers must ensure that all compensation is tracked accurately. Taxpayer identification information is collected, W-9 forms. Payments are properly categorized. Records match transaction files and escrow disbursements. This ties directly back to ARS, paragraph 32-2151.01, which requires accurate record keeping. If your transaction file shows one amount and your 1099 shows another, that inconsistency can create both regulatory and tax issues. Example: an agent receives multiple commission payments throughout the year, but some are processed outside of the brokerage's system. At year-end, the 1099 does not reflect total earnings. This creates exposure for both the broker and the agent. The key is consistency. Every dollar must be accounted for through a documented system. Illustrative example: how it all comes together. Consider a typical transaction in Arizona. A property closes, and the total commission is paid through escrow to the listing brokerage. The listing brokerage then distributes compensation to its agent and the cooperating brokerage. In this scenario, the listing brokerage must account for all funds received. Payments to its agent must be included in that agent's 1099. Payments to the cooperating brokerage must be properly documented. All records must align with escrow instructions and closing statements. If any part of this process is unclear, undocumented, or inconsistent, it creates risk, not just with the IRS, but also with ADRI during a compliance review. This is where strong policies and procedures become essential. Your policy manual should clearly define how commissions are processed, approved, and reported. Reporting deadlines and other information timing is critical when it comes to 1099 reporting. Brokers must provide 1099 forms to recipients and file them with the IRS by the required deadlines, typically January 31st for Form 1099 NEC. Failure to meet these deadlines can result in penalties, even if the information is accurate. In addition, brokers must maintain supporting documentation in case of audit. Example: a brokerage delays issuing 1099s due to incomplete records. Even if corrected later, the late filing may result in IRS penalties. This highlights the importance of maintaining accurate, real-time records throughout the year, not just at year-end. In 2026, many brokerages use integrated accounting and transaction management systems to streamline this process, reducing the risk of errors and missed deadlines. Antitrust compliance, compensation conversations, and risk. As we move deeper into compensation, we must also address antitrust compliance, an area that has become increasingly important in recent years. Brokers and agents must avoid any discussions or agreements that could be interpreted as price fixing, commission standardization, or limiting competition. This includes informal conversations between agents, teams, or brokerages about standard commission rates. Example: agents discussing and agreeing that we all charge 3% could be viewed as a violation of antitrust laws. Even casual conversations can create risk if they suggest coordinated pricing behavior. In 2026, with increased scrutiny on commission structures and compensation practices, brokers must ensure that their policies clearly prohibit anti-competitive behavior and reinforce that all commissions are negotiable. This ties back to broker supervision under AAC R4281103. If agents engage in antitrust violations, the broker may be held responsible for failing to properly supervise and train them. How this section connects forward. This section reinforces a key theme of this course. Supervision extends beyond transactions into financial systems, reporting, and compliance. As we move into the next section, we will continue building on this by exploring how trust account management and financial controls further protect the brokerage and ensure compliance with both ADRI and federal requirements. Online discussion. Why is 1099 reporting considered part of broker supervision rather than just accounting? Answer: because it involves tracking compensation, ensuring accuracy, and maintaining records that align with transactions. These are all responsibilities under broker supervision and compliance. What is the biggest risk when cooperative commissions are not properly reported? Answer: it can lead to IRS penalties, audit exposure, and inconsistencies that may also raise concerns during an ADRI investigation. How does antitrust compliance impact everyday conversations between agents? Answer: even casual discussions about commission rates can be interpreted as price fixing. Brokers must ensure agents understand that all commissions are negotiable and independent.